Hi, welcome to another episode of Orrick Live. I'm your host again, Aria Kashefi, partner in our technology group in the San Francisco office. And today's topic is flip transactions. We'll get to explaining what that is exactly. But before I do so, today joining me to discuss this are John Bautista, who is a partner in our San Francisco office. And for the viewers of the show, you'll remember John from the earlier episodes. And also is Kaitlin Bagby, my colleague, and a senior associate in our Silicon Valley office. So John, Kaitlin, welcome. Thanks for joining us. So Kaitlin and John, you've probably done, I don't know how many of these transactions, probably more than you've kept count of. So we're really excited to get your thoughts. And Kaitlin, let me just start with the question that everyone probably has, which is, what is a flip transaction?
Sure. So a flip transaction is kind of a vehicle for moving a company that's not domiciled in the United States over to the United States. There are a couple of reasons why companies might want to move to a U.S. holding company structure. Whether it's investors or because they're moving into the U.S. market. But essentially, what happens is you take a non-U.S. entity, and through the flip transaction, you end up with a U.S. holding company at the top, and then the previously non-U.S. company as a wholly owned subsidiary of the U.S. entity. And that happens via an exchange of shares or other equity interests. So what will happen is that the stockholders of the non-U.S. entity will exchange their shares or equity interests for shares in the newly formed U.S. company. So that's a high-level explanation of what the transaction looks like generally.
Got it. So essentially, let's say, have a UK company, and tomorrow after my flip transaction, I will own the shares of a US company instead, and the US company will own all of the UK company. So
that's correct. Yeah.
Okay, I got it. And John, when do you see companies do that? Why is this necessary?
Most companies will seek the flip transaction and want to set up a Delaware holding company because investors will demand it. Most venture capital comes from the United States, and most investors in the United States are more comfortable and used to investing in a U.S. corporation. And in that case, per our earlier segment on choice of state, Delaware. So in most of these flip transactions, the holding company is a Delaware company. And then the founders, as Kaitlin explained, will exchange their shares in the non-U.S. corporation or other entity for shares of the Delaware holding company. So it's principally driven by the need to seek capital and the objective of the founders to make sure that their company is set up in a way that makes it as easy as possible to attract capital from the broadest group of investors. The second consideration is employee equity. If a company is planning to have employees around the world and also employees in the US, most employees in the US are used to receiving stock or stock options in a Delaware corporation as opposed to a non-U.S. company. So if the company is planning to have significant presence in the U.S. Through its employees or advisors, that might be another reason to flip into the U.S. And the third reason is its own presence in the U.S. If the company is planning to pursue significant business operations with customers and contractors in the U.S., that might be another reason to set up a holding company in the US. And as we'll talk about in a couple of minutes, there's other ways to set up operations in the US per se without having to do a flip transaction. But again, the principal drivers around a flip transaction are the need to have a company that makes it as easy as possible to attract venture capital from U.S. investors.
Okay, so there has to be a really good business reason, it sounds like, for someone to do it. Usually that means attracting capital. And right now, venture capital is mostly located in the U.S. So you mentioned something, John, you said there is other ways maybe of doing business in the U.S. So let's quickly talk about that. And then we'll get back into the flip transactions.
Okay. If you're a non-U.S. company and you want to conduct business in the U.S., then you would simply set up a U.S. subsidiary, which could be a C Corp or an LLC. And that sub will employ people in the U.S. It may enter into contracts with customers and vendors in the U.S. And again, that will be a wholly owned subsidiary of the non-U.S. corporation. So that's usually a way non-U.S. companies start by, putting a toehold into the U.S. market if they're not planning to attract significant capital from U.S. investors.
Okay, got it. So it sounds like if you don't have employees in the U.S. that will want U.S. style equity, and you don't have investors that will want to invest in a U.S. company, then maybe there's an alternative that should be discussed. And, I think that's a whole other topic that we can do another whole episode on. And we should have you back on the show and do that. So, but let's get back into flip transactions here. And so Kaitlin, what happens in a flip transaction in terms of the mechanics? What are the major steps?
Yeah, so the first step is actually determining the equity ownership and structure of the non-U.S. entity, because the key is to really mirror or flip the non-U.S. entity structure into the U.S. entity. So, as founders, if the founder's considering, flipping to the United States, one of the key things is making sure that their non-U.S. company cap table is clean, straightforward. Everyone really understands who owns what, so that when you're working with counsel like Orrick, it's going to be very clear what can happen as far as next steps and who owns what post-transaction. So that's the first key step. The second is, your stockholders, they may be founders, as John mentioned, they may be employees who hold equity in the non-U.S. entity, and they may be investors. So for a lot of startups, if they've already raised an equity round from, investors in the non-U.S. entity, those investors are going to expect to have substantially similar terms, connected to the shares that they hold in the U.S. entity. So the second part, if applicable, is the founders need to work with their investors, their board, all their other interest holders to ensure that those investor rights are properly reflected in the U.S. entity. And that can be a little tricky because, of course, different markets, in Europe or Asia may have different standard market terms versus what's standard in the United States for stockholder rights. So that can be a second step as far as the U.S. transaction goes. The third step is kind of determining from a tax perspective what risk, if any, results in what tax risk results from the transaction. So many jurisdictions, a flip that mirrors the equity structure pre and post transaction is a tax-free transaction. But there can be certain jurisdictions where, in connection with the flip transaction, there is a taxable event. So it's really important not only to work with qualified U.S. counsel in connection with the transaction, but to also make sure that you're working with really good counsel, corporate counsel and tax counsel in the non-U.S. jurisdiction to confirm that there are no flip faults there. That kind of dovetails into the fourth step, if applicable in a flip transaction, is really determining what kind of flip you're going to do. There's the direct exchange, where immediately at the time of the transaction, the non-U.S. equity holders are exchanging their shares for shares in the U.S. entity. But sometimes if we have a tax event on the non-U.S. side, what we'll do is a deferred exchange or a deferred flip. And what that means is the U.S. entity, the non-U.S. entity, and the current non-U.S. entity stockholders agree to enter into a transaction where at a later date, whether that's a liquidity event or some certain time period, they will then exchange their shares for shares in the U.S. entity. And what that does, right, is, private companies, there's no liquidity transaction at the time that you're a U.S. private entity. And so it's really deferring the tax resulting from the flip transaction to a time where the stockholder may have the funds to cover the tax obligation there. So those are kind of the key major steps.
Understood. So essentially, this is an exchange, right? It's so I have shares in a non-U.S. company. I give those shares to the U.S. to this newly created U.S. company, which, by the way, we did a separate episode on how you create a new U.S. company, and I encourage people to go see that. But I create a new U.S. company. I exchange my shares for the non-U.S. company for shares of the U.S. company. that in some jurisdictions can give rise to taxes. So I need to be able to know exactly what taxes I'm subject to, and make sure that if one of those jurisdictions will tax that transaction, that's properly addressed in structuring the transactions. Okay, and where do we see these transactions get I mean, it sounds complicated to begin with, but where is it really? What is the meat and potatoes of the issues that give rise to complexity here? John, I don't know if you've seen a lot of recent things come up that's a trend.
Yes. Well, as Kaitlin pointed out, the structure of the transaction is determined a lot by tax considerations. And the tax considerations are dependent on the tax jurisdiction of the individual stockholders. For example, even if you have a UK company that you want to flip into Delaware, but that UK company has shareholders who are French or German. What makes this complex is you have to look at whether the exchange of shares triggers tax based on the tax jurisdiction of the shareholder, independent of what the domicile is of the corporation. So that's one thing that makes it tricky. And, as companies expand that are non-U.S. companies and they add more shareholders, in a sense, they're adding to the complexity of a future flip transaction. So many companies, have to decide, when they will flip. And our view is if there's a strong possibility that a founder team will want to flip their company into Delaware, it's better to do it sooner rather than later, because as they take on capital from investors, not only will the flip transaction need to replicate as best as possible the rights that the company negotiated with those investors in the Delaware company, but the tax issues become more complex because investors may be coming from many additional tax jurisdictions. So it has to be looked at from all of those perspectives. The objective of the flip transaction not only is to have a Delaware holding company, but it's also to ensure that the Delaware company owns and controls the subsidiary. The flip transaction does not replace the company's desire to continue its operations in its existing country. And in fact, many companies that we work with, they have set up a Delaware holding company through the flip transaction, but they don't actually have employees in the U.S. They continue to build their team in the U.K. or France and Germany. Those employees are employed by the subsidiary in those countries, and the holding company is simply a vehicle to attract capital. But it is important when investors look at investing in the holding company that the holding company own and control the subsidiary, because it's at the subsidiary level where the intellectual property is located, where the customers are located, where the employees are located. So either the flip will occur such that Delaware will own 100% of the non-U.S. company. That's the objective, and that's the easiest analysis. But if the Delaware company does not own immediately 100% of the subsidiary, and instead some of the shareholders for tax reasons had to do a deferred flip, then that adds complexity. So in summary, the objective of the Delaware company is to own 100% control of the subsidiary. And if that's not the case, then there needs to be rights in place whereby the Delaware will ultimately own and control 100% of the subsidiary, for example, on a liquidity event like an IPO or an acquisition of the company. Another factor that can get complicated over time is as the non-U.S. company adds investors, more and more rights start to be granted to investors. And when you do the flip, it becomes more complicated because the Delaware structure has to be set up to replicate as best as possible the rights of those investors. Many times we've seen investors object to the Delaware rights because they believe that the Delaware rights are not as good as the rights that they negotiated with the non-U.S. Company. But one of the things that we do, and it's important for founders to consult legal counsel, is not only do you want to replicate the rights of the non-U.S. investors in the Delaware company, but you also want to ask, are those rights going to be acceptable to future investors? And many non-U.S. investors ask for a lot of rights in companies. And when we look at it, our advice is we need to modify some of these rights to make the company at the Delaware company level more attractive to investors at large. And we usually follow standards like the National Venture Capital Association in the US as to what are acceptable rights for investors to have in companies. So sometimes as a company gets more complex before they're flipped, there's a process of negotiation with existing investors to regulate their rights as to what we commonly see for Delaware companies and US based investors.
Understood. Yes, because I suppose there's no point in being a U.S. company if you're not going to look like a U.S. company and therefore not achieve your main objective, which was to attract capital from the U.S.
That's exactly right.
And you and Kaitlin brought up two other points that I thought were really interesting. First one, which I'll just quickly mention again, is that just because the company is moving to the U.S. doesn't mean the founders or even the employees or anybody else has to move to the U.S. It doesn't by itself make those founders and employees subject to U.S. taxes.
That's an important point, Aria, which is we get the question from founders many times, which is, will I be subject to U.S. tax because I'm a stockholder in a U.S. corporation? The answer is no. Simply flipping to the U.S. does not subject the stockholder to U.S. tax. But the other thing that founders should be aware of is there's no requirement that the officers and directors of the Delaware holding company be U.S. persons, either citizens or residents. So you can be a UK citizen and still be the officer, director, and shareholder of a U.S. corporation. So there's no need to move to the U.S. You don't have to have a physical presence in the U.S. In order to have a holding company. And the intellectual property of the company also does not need to move to the U.S. As I mentioned earlier, the intellectual property is usually continuing at the subsidiary level in the native country, and investors are perfectly fine with that. In fact, there may be tax advantages to keeping the IP outside of the U.S. The most important thing from an investor perspective is that that IP, to my earlier point, is ultimately owned and controlled by the Delaware holding company.
That's right, because it owns all of the non-U.S. company. I got it. And then the other interesting point, which both you and Kaitlin brought up, was this concept of a deferred flip, where the flip actually doesn't happen right now. The exchange doesn't happen right now, versus I suppose we can call it an immediate flip, which is the exchange happens right now. And this is driven by tax structure. Kaitlin, do you want to maybe elaborate a bit on that point, and maybe if you have any examples of jurisdictions that you've worked recently with where you did one or the other?
Yeah, sure. Happy to talk about that. So at a high level, the reality is owning the deferred exchange structure for the company is going to be more expensive to own. It's going to be more expensive to administer, because not only do you have further complexity to the transaction, but as the company looks to raise additional capital from U.S. investors, there's going to be a little bit of a learning curve with a lot of U.S. investors and your stockholders and your employees that you grant equity to as well. So that's certainly a consideration when investigating whether or not to move forward with the deferred exchange flip. Recently, kind of the two jurisdictions that we probably see it happening the most in, maybe three. Canada is one of them that we've seen a fair amount of deferred exchange transactions given the tax structure with respect to Canadian stockholders. Another is, many French stockholders might be subject to tax in connection with the flip. So that's often a situation where we'll investigate whether that structure is more appropriate. And then sometimes also Austria might be another situation where we'll have to look further into whether or not a deferred exchange might be appropriate under those circumstances.
I would add to that list, Germany as well raises significant issues in doing a present flip, and many times we'll need to consider a deferred flip. And the other jurisdictions are Spain and Israel. So many times we encounter tax issues in those jurisdictions as well.
Yeah, and of course, I believe Finland is one to add to the list there as well, John. And then, but on the other side, for example, or Nigeria, I understand are examples of countries where it's easy to do an immediate flip.
Yeah, UK, for the most part, France, except for some special investor requirements, and Nigeria, as you mentioned. For the most part, we see countries, Singapore is another one, where you can do the flip without incurring tax. The important factor, as Kaitlin mentioned earlier, to avoid tax is the capital structure, the ownership allocation between the stockholders before the flip transaction needs to be the same immediately after the flip transaction. So they need to own the same percentage ownership in Delaware as they owned in their subsidiary prior to the flip.
Understood. Okay. And in your experience, if a company has to do a deferred flip because of the tax consequences in their local jurisdiction outside of the U.S., has that disadvantaged these companies down the line in terms of being able to raise equity financing or doing even a sale transaction?
I think it's achievable. It's really important that deferred exchange agreement have enough mechanisms to ensure that if there is a sale of the company or an IPO, that those shares can ultimately be exchanged up into the Delaware holding company. So usually what we have in place is a put and call option provision in there, where the stockholder has the right to put their shares to Delaware, and also where Delaware has the right to call the shares. But in order for that put call mechanism to work, it has to be enforceable in the local jurisdiction. And so then you get into enforceability issues around that. So, it's very important to have legal counsel look at these deferred exchange agreements. And we want to be sure that on due diligence by investors or at acquisition, that the agreements are ultimately enforceable so that the Delaware company can own 100% of the shares of the subsidiary. The tax issues that we're talking about really arise when a flip occurs after the formation of the subsidiary or the company, the non-U.S. company, and there's been an increase in value of that company since the date of purchase by the founders of their shares. Because the tax issue is in some jurisdictions, as we pointed out, the tax authorities may take the position that because the company has increased in value through investment, through intellectual property development, through third-party valuations, that when the flip occurs, the Delaware shares that the founders and stockholders are receiving have a value that's greater than the original purchase price. And that is the tax issue that we're focused on, and the capital gains associated with the spread between the value of the Delaware shares and the original purchase price of the non-U.S. company. It's that capital gains tax that we want to make sure the founders don't have to pay. And again, in some jurisdictions, if the ownership pre-flip and post-flip are the same, the tax authorities will not deem that to be a sale, and therefore there's no capital gains tax. But in other jurisdictions, the tax authorities may deem the flip to be a sale, and therefore that generates capital gains tax liability.
Understood. And I think I'll add to the list of tax concerns are stamp duty taxes in some jurisdictions, of course, that we definitely don't want people to pay if they don't have to. Well, that's all very helpful. I think the overall kind of message here is that even a relatively simple flip transaction can be quite complicated. And as with all things that are tax related, one needs really good advice and advisors, both on the U.S. side and on the non-U.S. side, to guide them through this. So companies would be well advised, I think, to think and make sure there is a good enough business and strategic reason to embark on this adventure. But if there is, to do it as soon as possible, as soon as they identify the need, and experienced advisors to help them along, and hopefully that will all end up in the long run to have been worth the work of a flip transaction. Any final thoughts, John or Kaitlin?
Once the flip is completed, the company will also have a stock plan and will grant equity to employees around the world, in the U.S. and in the jurisdiction where the non-U.S. company started and still has operations. And, we're experienced at granting equity, whether from the Delaware company, whether it is to employees in the UK or France or Germany or other jurisdictions. So post-split, that's the very next step that founders will look at, is how do I then continue to grant equity to my employees. The founders will not want to continue to grant equity in the subsidiary. All equity grants to employees will then proceed at the Delaware company level, just as the objective being all preferred stock sold to investors going forward will be at the Delaware company level.
Understood. So all roads lead to Delaware in this case.
Exactly.
All right. Well, John, Kaitlin, thanks a lot for being here and sharing your experience with us. Hope to have you back here again soon. And that concludes our episode.